Thank you, Miria, and thank you very much, everyone, for joining our virtual Lunch and Learn session today. For many of you already, I saw from the registration list, many of you already know me, but for those who don't, my name is Alexis Khan, and I'm the cash management sales manager at Chelsea Groton. So I am responsible for helping our business and nonprofit customers with their deposit account needs and cash management needs. So I already know a lot of you quite well, so I was happy to see a lot of familiar faces here today. So we are continuing our, in a virtual capacity for the time being. We're hoping that at some point very soon we'll be able to start again having some business classes in an in-person environment as we've had in the past with some of you. But for now, wanted to kind of continue in a virtual capacity to bring you content that we hope is going to be beneficial to you as you're kind of considering particularly, where to go from here. There's been a lot of turmoil and certainly uncertainty over the last year with COVID. And I think while we've done this class on financial forecasting prior to COVID occurring, and while it's certainly a very beneficial topic of interest for business owners who are looking at, sort of if there's different considerations for growth or if they're considering some financing opportunities, how that fits into their overall forecasting plan. But now more than ever, it seems like a very relevant topic, given the fact that you can't necessarily go off of historical data when there's so much that's still yet to be seen and playing out in the world, and the implications on different business and industries as well. So we thought it was a very topical subject that we wanted to cover today. So we thank you again for being here. I think the format we wanted to just, there'll be a presentation that will be approximately 30 or so minutes, but we want it to be also really interactive. We understand that there's a lot of different considerations based on business model and industry type. So certainly questions are going to be very welcomed. So please feel free to make this as interactive as you'd like. And so I will, with that, want to just turn it over with a brief introduction to our guest for this lunchtime session, who's Randy Wyrofsky, who's a CPA. I'll just kind of give you some brief highlights of his bio. Randy began his career in public accounting, spending 8 years in a Big Four accounting firm and 4 years in a medium-sized accounting firm. And Randy spent 16 years following public accounting as the CFO of the Jean Coutu Group USA, which operated retail pharmacy drugstores. And for those of you who are native to this area, you may remember Brooks Pharmacy, which then it was Brooks Maxi Drug, which then became Brooks Pharmacy, which then became Eckerd Pharmacy. So that brand might mean something to you if you're from this area. During his tenure at the CJC Group, the chain grew from 6 stores to 1,850 stores, primarily through acquisitions. Immediately after the sale of CJC to Rite Aid Corporation in August 2007, Randy helped form the Catalyst Group, a private equity firm, with the former CEO of CJC. Randy also served as the CEO of the Fishers Island Ferry District, for those of you, again, in the area who have been to Fishers Island for a brief period. And he also served as CFO of Home Loan Investment Bank for 5 years and as Executive Vice President, CFO, and Information Security Officer of Independence Bank in East Greenwich, Rhode Island. Randy was also a member of the Board of Directors of Blue Cross and Blue Shield of Rhode Island. And at various points during his tenure there, he served as chair of the Audit and Finance Committee. He served as board chair from 2015 until his term ended in 2019. And he also served as the board chair of the Greater Cranston Chamber of Commerce in Rhode Island. He serves as an adjunct professor at the University of Rhode Island's MBA program, where he has taught financial accounting, financial management, and managerial accounting courses. So with that, I will turn it over to Randy to start the presentation. Thanks, Randy.
Hello, everybody, and happy Wednesday. And I'm going to try to keep this as fast moving as possible because an hour can seem like forever if you have something that drags along. And the last thing that you want in midday is to have to fall asleep because the speaker is boring. Now, when you think about financial forecasting, it's not necessarily something that's so very exciting, but financial forecasting is a really critical component of any kind of business. And some people do it very formally, and other people have been able to, especially in smaller business, can kind of just get a feel for forecasting and get it right. So we just want to go through some basic considerations for your thoughts. And I think in light, I sent out the questionnaire previously. I didn't send it out, but it was sent out. And the whole idea was financial forecasting in a time of extraordinary uncertainty, such as COVID-19, has really made a lot of businesses operate differently in order to survive. Fortunately, there's been a lot of federal money available to small businesses in the form of PPP loans, other sorts of financing. And the SBA has really pretty much stepped up over the past year plus in trying to create a role to get the country back in order. And there's a lot of programs that are out there, and there's some actual financial maneuvering that businesses have done using PPP money to refinance other debt, which is interesting to watch. So if there's no other, before we move on, are there any questions or any thoughts before we get going? Okay, so we're moving along the slideshow. So the agenda, what is financial forecasting? Why is financial forecasting important? And what are the elements of financial forecasting? And I just want to go through kind of a brief example of a financial forecast, very rudimentary, but just gives you an idea of some of the mechanics that are associated with doing an actual financial forecast. As Alexis mentioned earlier, I mean, we had, when I was with the Jean Coutu Group, the USA operations, financial forecasting was extremely important because what our plan originally was to open store by store. We found that was too much of too onerous on our financial statements, and so we determined that growth through acquisition was much more beneficial. I mean, you have like distribution channels, you have people in place. There's a whole bunch of infrastructure elements associated with doing an acquisition, especially when you're acquiring something much larger than you are. There's a lot of things that you can get out of just by buying something. So you can imagine financial forecasting was really critical. And for the most significant component of it was, what price do you pay for a particular business? How do you determine a price? And so the financial forecast actually played a very, very large role in making that determination on what you offer for a particular business. As Alexis said, we grew 6 stores to 22 stores, then 22 to 240, then 240 to 330, and then 330 to 1,850 stores. So we did some pretty significant growth through acquisitions, and I have a lot of scars on my body from all of the wounds that were inflicted by going through this process. There were a lot of sleepless nights, but it's a good process to go through. A lot of people don't like to do it, but it's something that's really important. So moving on, what is financial forecasting? First and foremost, financial forecasting, it attempts to predict the future. And if you could predict the future, you can go to Foxwoods and gamble, and you wouldn't have to think about these things. You'd hire people to do those kinds of things. But the past is the past. In some cases, it's not necessarily really the past when we start to talk about the balance sheet. But we're trying to do guesswork in terms of what we think is going to happen in the future. And you're guessing in general, but essentially what we're trying to do in the financial forecasting is to guess in the format of a balance sheet, income statement, and cash flow projections. Financial forecasts generally go out 3 to 5 years. Once you start getting past 3 to 5 years, and you could even argue that And anytime you go out past 1 year, it's probably going to be fraught with peril. I mean, if you were doing forecasting in 2019, and then you didn't know about COVID, and then COVID struck, your forecasts were probably off, and it could be off in a negative way, it could be off in a positive way. But there are things that you can't necessarily predict, but you do everything that you can as best as possible to try to predict it. So, clearly doing a shorter term forecast, will enable you to identify what working capital needs that you have, at least for the next 12 months. And again, it's the farther out that you go with the forecast, generally the less reliable they tend to be. When you are looking to acquire a business, or you're looking to acquire a piece of equipment, which represents a major financial investment, you generally want to go out a little bit more. And those types of things are a little bit easier to forecast, especially buying a business, because the business had been in place for some period of time, so you can kind of use that as a means by which to predict the future. So you're predicting the future is basically what the long and the short of it is. So financial forecasting, the way I like to express it is that it's very similar. And in fact, the financial management is very similar in a business environment as it is in a personal environment. So whether you realize it or not, you're making personal decisions that you're doing forecasting, and you're doing it in the form of financial forecasting. So, I got a couple of examples here where it pertains to personal financial forecasting. It's like, I want to buy a house. I don't want to rent an apartment anymore. I want to buy a house. Well, how much of a house can I afford to pay? I want an automobile. How much can I afford to spend on an automobile? And any excess amounts I might want to invest for the future, maybe in a 401k plan or a separate Roth IRA, something like that. So the financial forecasting component of this really enables you to make that kind of determination, because you're predicting, especially if you're buying a house and you're going to secure a mortgage, you're predicting what you think your revenue stream is going to be over the period of time that you're going to be financing the house. And I can assure you, especially in this market, lenders such as Chelsea Groton are looking very, very carefully at what you can afford, and hoping that you're going to be able to afford it in the future, so that you don't become a casualty and a real problem to the bank. The same thing with automobiles. You're making investments, you're generally going to finance it in most cases. So I always say the default, if you're going through a business financial forecasting model and you get stuck on something, generally just think about, well, if this was a personal matter, how would I view it? And I always find that defaulting back to that can really help you out in a lot of ways. The financial forecast can be very complex, as you can imagine. The more complicated the business is, the more complex the financial forecast is, or it could be very simple. And either way, I think it's good to go through the exercise of doing the financial forecasting in a business. Even if it's back of the envelope, just to be thinking about it, because the past, it can be indicative of the future, but the future has some twists and turns that may shift. And so going through this exercise at least once a year is probably a good idea. Now, if your business has been impacted significantly by COVID, you're probably looking at weekly or monthly forecasting to determine what kind of impact that this is going to have, and can you even survive. We've seen a lot of businesses that haven't actually, they've closed as a result of COVID, even with all of the funding that's out there from the SBA through the government. Businesses just, a lot of businesses, especially restaurants, are right on the teeter. They're right on the edge anyway, just because that's a tough business. And I'm just looking at this, and I just created a new word, by the way, AFFORD. So now I'm looking at it, I'm like, does this make sense? But anyway, so anyway, that's that. And let's see. Why is financial forecasting important to a business? I mean, if you look at the financial forecasting, you have a business model. If you're in business, you have a business model. And the question is that business model financially feasible? Does it make sense? You may have a business model that's currently financially feasible, but there are elements in the marketplace that might be changing. And so that business model might not be viable in the future. Or there may be elements of competition that come in that significantly impact the business. and the business no longer can be viable. I'll give you an example. In my independence days, the bank did predominantly SBA lending. And these are businesses that, no credit elsewhere. So the businesses go to SBA because they can't get a conventional financing, usually because of deficiencies in collateral requirements. So there was a pizzeria that we lent money to in 2013. And the pizzeria did very, very well. It was a very good business. And then a series of things happened 4 years in. Number one, the principals wound up getting sick. They both got various degrees of diseases, so they couldn't focus on the business as much as they had previously done. And then there was competition that moved in. And basically, after 5 years of very strong financial performance, they had to basically pack it in and close the business down. Now, in larger companies, that usually doesn't happen that way because you have succession planning and you have multiple people that can go into different roles. But smaller businesses have that kind of impact. So it's something to consider. A good financial forecast, and this is especially true in the case of COVID, good financial forecast can help determine if the business can survive under stress. And there are different elements that you can subject the financial forecast to really kind of test that stress type of an environment. If the business plans to have significant growth or considering acquiring another business, we talked about the Jean Coutu group, doing acquisitions of other businesses at a multiple of what the current business was. Having this business process of analyzing financial information and making a determination in the future what type of impact that's going to have. There's a lot of things to think about. And as importantly, the capital structure considerations are important. Now, for those of you that are not familiar with the term capital structure, when we get into the balance sheet, we'll talk about this more, but capital structure considerations are very, very critical to financial forecasting. Again, anytime if anybody has a question, just feel free to jump in. And I just realized I had a kind of a brain fog when I looked at the word afford. For some reason, that just didn't look familiar to me. I was like, oh, I think I invented a new word. And now I'm looking at it, I'm like, oh, okay, Randy, stop drinking coffee. All right, but yes, please just jump in at any point if you have any questions. I'm happy to speak. I have a tendency to speak fast, so that's not necessarily always good. So generally, if you're going to be in your business, you would develop. Anybody that has a business background will tell you, develop a business plan. I'm working with an individual right now who's got an idea which I think has some merit to it, and I'm having him go through the exercise of developing a business plan. Because, excuse me, because the business plan basically flushes out all of the elements of the business that need to be considered. And for all of those elements, for the most part, there's a financial ramification that needs to be built into financial forecasts. So, what's your marketing plan, what's your advertising plan, what's your distribution channels, who are you going to access your information, your goods and services from. So these are all things that are built into a business plan that ultimately get codified into the financial forecast. So what does the business want to do in the future? These are decisions. Oftentimes, if you're in a company, you'll get your CFO, your chief marketing officer, the CEO. And in a lot of cases, if you have a tech play, you'll get your chief information technology officer. And you just get around the room and people just throw out ideas. And generally, the CFO is the one that's collecting all those ideas and determining what the financial ramifications are and putting it into the financial forecast. So what are the financial ramifications associated with where the business wants to go? And you think growth is good, and it is good, but there are certain financial ramifications or considerations that could put pressure on the business in a growth mode. So those need to be considered. Is it financially feasible to do what the business wants to do? I mean, that's hopefully what comes out of this. You can have some great ideas, and then you put pen to paper and you find out that this isn't going to work for whatever series of reasons. We're going to talk about it a little bit. If you have a current business and you're doing a financial forecast for your current business, really the two big statements that you want to take a look at You want to analyze the historical balance sheet and the income statements for several years. Usually you want to go back 2 to 3 years in your balance sheet and income statement. And part of what you want to do is to determine what associations that the balance sheet and income statement have. In other words, so for example, you may have a certain level of sales. If you do sales on account, there's going to be an accounts receivable component. There'll be an inventory component. So in order to support the income statement, the sales that you're looking to do. So, and that's going to have a balance sheet impact. So having a fairly good understanding of the balance sheet and the income statement, and more importantly with this, you want to strip it down to its bare minimums. So if you have unusual items that affected the balance sheet or the income statement, you have to consider whether those are going to happen in the future or whether you really need to pull those out as a base model. So having that understanding of what's in your balance sheet historically, what's in your income statement historically, really becomes an important component of determining what's going to happen in the future. Worst thing that you could do, and I've seen this happen on many occasions, I'll give you a perfect example. You run out of cash. You're in a growth mode and you run out of cash, and next thing you know, you're out of business, even though you have this business that is going strong. And I'll use an example. A former student of mine opened a pharmacy in Providence, actually with the help of Independence Bank. We did the financing for him. And it's a pharmacy business. So what are the components of a pharmacy business? The components are you got payables, you're buying drugs from, usually in this case, a wholesaler. You got receivables. The receivables are coming from Blue Cross Blue Shield of Rhode Island, all the plans that are basically that insure the participant, and you have inventory. So in a lot of cases, your receivables and your inventory have to be paid, or you're going to get paid on you're going to have to pay for the inventory through accounts payable, and your receivables are going to hang out there a lot longer. And so you're in a growth mode. He was in a growth mode, a significant growth mode. He ran out of cash. His receivables climbed, his inventory climbed, his payables climbed, but not to the same extent. And we had to get him a bridge finance for about 6 months period of time until his cash flows kind of worked out. So if he wasn't able to get bridge financing at that time, he would have gone out of business. So always keep in mind that, growth sounds good, but consider all the working capital requirements and make sure that you have enough cash. There's schools of thoughts about having enough cash on the books. You want to try to have as much of a cash cushion as possible, especially if you're thinking about going into a growth mode, because all sorts of things can happen to chew up that cash, and you don't want to run out of cash and have no place else to go. Okay. Now, the most significant challenge with financial forecasting, and people try not to do this, but it's really, really hard. Eliminating bias from the forecasting, I've come to find out, often proves the most difficult aspect of forecasting. And you can only imagine how many entrepreneurs I've run into that I've helped over the years in their forecasting, because they think that the revenues are going to go through the roof because the idea is so great and everybody's going to want their product or goods and services, that the numbers are going to just blow through the roof. They're going to set records and everything is going to be great. Well, right there, they have a bias, because, if you're in your business, you're passionate about it and you think highly of your business, and that's why you're doing it. And you want to be the best cheerleader in the business if you own the business, because that's the way to get the business moving. But that introduces an element of bias. I always say people think the revenues are going to be great, and they think the expenses are going to be small. And next thing you know, the revenue is 75% of what they think it's going to be, and the expenses are 120, 130% of what they think it's going to be. So really taking a look and trying not to be biased. And this is where it's good to have somebody doing the forecasting with you, like your CPA or somebody that can challenge you and say, look, okay, I understand you're excited, but let's think about this rationally, because we certainly want to make sure that we don't introduce bias, and the bias, it just makes the forecast essentially worthless. or not as worthwhile. And more importantly, you start to operate the business on that forecast, and then you start tripping over certain things, and this can be a real problem. So to the extent that you can do it, and it's very difficult, try to eliminate, try to just be as balanced as possible when you start to go through this process, because it's really important. So we talked about the elements of the financial forecast. We start with the balance sheet. The balance sheet is really important. It's a snapshot in time. And for most small businesses, it's a pretty good representation of what your assets, liabilities, and equity are at a point in time. You get into bigger businesses, you have some uncertainty. So back at the bank, and I know Chelsea Groton deals with this, is, the balance sheet is supposed to be, when you look at loans receivable, for example, for a bank, that loans receivable is supposed to be reflected on the net realizable value of that asset. So you can have a gross asset of receivable or loans receivable, and then there's an expectation certain of those loans are not going to perform. So you have to estimate what you expect that you're not going to get paid. And so what you're reflecting on your balance sheet is that net number of what you actually expect to receive. Well, you're guessing into the future. So in that case, the balance sheet, even if it's a snapshot in time that reflects past activity, you're not necessarily going to know how that plays out until a future time. And there's all sorts of examples of that. But what are the assets and liabilities of the businesses at a point in time? So ordinarily it'll be at either the end of the quarter, or at the end of halfway through the year, or the end of the year. Generally, you take that snapshot. So assets minus liabilities represents the equity in the business. That's why it's a balance sheet. Assets equals liability plus equity or capital. The key element of the understanding this is that assets basically drive revenue. So assets driving revenue, you want to make sure that you have the appropriate assets in place to be able to recognize revenue on those assets of the business. Now, the trick is, if you had your druthers, you would have the minimal amount of assets to drive the maximum amount of revenue. But that's where the fine tuning and the finesse is as part of this, because you're going to need a certain amount of assets to drive revenue. The trick is not to have too many assets, because on the flip side of this, again, because we have a balance sheet, and on the flip side of this, every dollar of asset that you have incrementally requires either you have to borrow against it, or you have to have sufficient capital to be able to grow. So ordinarily, what you want to try to do with this is you want to incur liabilities, because it's generally lower than your cost of capital. But in some cases, you may need to raise capital. So if you're doing acquisitions, you have to consider this. So always think about trying to maintain the minimum amount of asset to generate the most amount of revenue, and that's kind of a mindset that you want to think about. So this is an example of a balance sheet. ABC company has cash, accounts receivable, inventory, property, plant, and equipment. So this could be the pharmacy to which I referred. Have some payables, some accrued payroll and taxes, liability, and then the equity. As you can see, the balance sheet balances. And it's really in the movement of those balances over time that you want to be considering as you forecast. So what are some of the important things about this? Notice I do percentage to sales. So I've made a determination that there is some kind of correlation between the values that are on the balance sheet and the level of sales that I'm doing. And oftentimes there is that correlation. So I'm saying, all right, it's 1% of the total sales. The accounts receivables are 8.33%. Inventory is 5%. And the reason why, especially accounts receivable, inventory, and accounts payable, is these are all part of that. You're acquiring products for either resale, or you're manufacturing it. Ordinarily, there is a correlation between what the accounts receivable, inventory, and accounts payable are, and what the level of sales are. And this becomes important in the forecasting, because it gives you a basis to say, all right, I anticipate I'm going to do 5% more in sales. What do I think the impact's going to be on accounts receivable, inventory, and accounts payable? You can look at your historical trends on what that was in the past, and you can apply that in the future to see what your balance sheet looks like. Okay? And of course, it's all the way in the bottom balance. You'd be amazed how many when I was back at the bank, and people, the lenders, I mean, the underwriters would ask me to take a look at a balance sheet, you'd be amazed how many times I would look at a balance sheet prepared by a CPA and it didn't balance. I mean, that's just amazing to me, but these kinds of things do happen. So if you're going to be going to a financial institution with a CPA and you're going to try to borrow money, make sure your balance sheet balances, because that's like a big red flag for banks. Okay, next we go to the income statement. Income statement shows the financial impact of the operations of the business for a period of time. So whereas the balance sheet is a snapshot, the income statement is for a span of time. It's either a month, a quarter, or a year. And in the body of the income statement, it'll indicate exactly what it is. So looking at trends on the income statement, how the business has behaved over time, how the expenses behave relative to sales movement, this is an important component that helps with the financial forecasting. So this is all stuff you know, but it starts with the revenue from the business operation, then deducts expenses to arrive at net income, and hopefully is the case, right? Hopefully you have you're not spending more than you're earning, and because that's a bad spot you don't ever want to be in. An income, an example of an income statement, revenues of 100,000. I showed relatively consistent measures, again, percentage to sales. Because that can help drive, when you make your sales forecast, that can help drive what your expectation is for expenses as the business either grows or it decreases. And so you come down to net income, and again, it's the same type of relationship. So the percentage to sales, I mean, you think about your particular business, what are the drivers that reflect, here's the revenues that I'm going to earn, what's the expense structure look like, and is there any kind of correlation that I could utilize for the future in determining what I can estimate in terms of expenses, balance sheet items as a result of what my forecasted sales is going to be. Okay. And then the elements to a financial forecast on cash flows. Again, we talked about the importance of cash flows. Cash flows are really important. And the reason why the accounting industry back in the 80s went from the statement of changes in working capital, they changed it to a cash flow statement, because a number of businesses basically were profitable, but because of the nature of their operations, they ran out of cash. And so the AICPA and the FASB said, we need to make sure that we have a financial statement that really focuses on cash, because cash is the situation where, you could go out of business, you could have income, you could have an otherwise good looking balance sheet, but the operations, and I talked about it with the pharmacy business, the cash flows really showed the impact of a growth on cash flows. So it's very important to consider cash flow as part of the analysis, especially if you're going to be growing. So this is an example of a cash flow statement for the company. We start out with income. We show the changes in all of the different working capital items to come up with cash from operations. Now, in a situation, I'll use a perfect example. I looked at a company. I was working with a company for a while, and I was looking to try to help them. They earned a lot of their revenues. They were paid for a lot of revenues that they ultimately were going to have to provide services for in the future. And these are a lot of computer software companies. So they'd wind up with these big chunks of cash, especially initially on the financial statements. When you did this analysis, that if you don't earn the revenue, you have to actually defer the revenue. You recognize revenue when it's earned, not when you actually receive the cash. And if you looked at this particular company's financial statement, they showed income. But when you did the cash flow statement, because they had so much in deferred revenue, the cash generated from operations was actually negative. So that's a warning sign to be careful about the business. So in this case, I had net income of $35.70. The change in accounts receivable, my accounts receivable increased, right? So that had a negative effect on cash by $167. Same thing with inventory, and same thing with the payables. Payables, I got a benefit, but as you can see in this example, the change in accounts receivable and the change in inventory exceeded what the change in payable was. And as a result of that, it decreased the cash from operations from net income. But in this case, the cash from operations was still very positive, at $3,400. We had an investment in equipment. I tried to keep this simple. So if there were any financing activities, if there was an equity raise, or if there was a borrowing, that would be a separate line item. So we had net cash flow, beginning cash, ending cash. I mean, in this particular case, it's a pretty good side. So the approach to financial forecasting, you do it in various steps. Okay, the first thing that you do, if you have an existing business, you forecast what you expect your revenues are going to be. And this is usually the process of the most heavy lifting. Because if you have a business and you say, okay, how did I earn those revenues in the past? What types, if I want to grow the business, what types of things am I going to need to do to increase those revenues? Or in a lot of cases, if I have significant competition, how do I maintain those revenues? Okay, so forecasting revenues, what kind of advertising, marketing that you need to do in order to generate that, that comes into the expenses, which is step 2. Forecast the expenses to earn those revenues. And then forecast the impact on the assets as a result of the forecast, right? And then you're going to see that, you know, if you don't have sufficient liabilities or capital, so I increase the asset, where's it going to come together on a balance sheet for liabilities and capital? And you may have to do a debt raise, or you may have to raise a capital. So part of the forecasting determines what kind of capital structure you need to change in order to be able to have that kind of forecast. And then again, determine whether there's sufficient capital to operate the business. Keeping these in mind, making sure that you understand all the different components of it is a really important thing. Stress test for the financial forecast. This is probably one of the more important things you could do. I could spend a lot of time on this. Maybe this is a future session, but because predicting the future is so difficult, it's advisable to do stress testing. So basically with stress testing, you want to look at a base case. Here's what I think is going to happen. Here's if everything goes great and everything that I think could go good goes good, nothing goes bad that I think might go bad. What does that look like? And then the worst case. Now you think to yourself, well, why do I want to think about an optimistic case? That's a good thing. Well, because if you think about the optimistic case, you don't want to be in a position where you can't do the optimistic. You can't do all the business you want to do because you don't have sufficient working capital. So looking at the optimistic case and doing more business than you thought is another kind of conversation. It's not the conversation of, am I going to go out of business? It's a question of like, how do I finance this? And maybe I have to grow a little bit more slowly because I need the revenues from the business to build capital, and through retained earnings, I'm able to then, increase the business, increase the revenues of the business and the profitability. For focusing on the worst case first, obviously, is because you want to make sure that whatever you come up with doesn't put you out of business. And so, again, you can get very exotic in terms of stress testing, but consider, base case, optimistic case, and worst case on the financial forecast. So here's a couple of different types of analysis. Sensitivity, you start with the base case and change each of the assumptions individually and determine the impact on the financial forecasts. So that's, you have, say, for example, you're selling some goods. So you say, okay, what's going to be the price of the goods? What's going to be the quantity of the goods? And so that becomes what your sales items are, right? So what if your costs are higher? What if you can't get the same kind of revenue? You would change each of those determinations of the assumptions, and then you would see what kind of impact that has on the forecast. And then the scenario analysis says, all right, I'm going to start with the base case, and I'm going to create a scenario. For example, inflation increases the overall impact on overall costs, but I can't increase unit sales cost due to competitive pricing issues. So, what's the impact of inflation? The Fed has been indicating that they're not going to raise rates. Interestingly enough, inflation's taken off. You could probably see it at the gas pump. You could see it in the stores. That's going to be something that's going to be very interesting to watch how the Fed reacts to that, because generally speaking, inflation and the Fed funds rates are tied because they have an impact. That's a separate discussion. Using the assumptions, just make sure you can go through the process of going through the mechanics, and you could wind up with something that doesn't make sense. So just make sure that you step back after you do the financial forecasts. You step back and you say, does this make sense? And so I'll give you an example. When we did the Eckerd Pharmacy acquisition, this is a pretty big deal for us anyway. For bigger companies, it wasn't that big, but We were essentially 330 stores, and we were acquiring, like I said, 1,500 stores. So we were using Merrill Lynch and Deutsche Bank to help us with the, the investment banking and all that stuff. But the trends in the late 90s, when we were actually going through this the first time, the trends in pharmacy were just off the charts. So we were seeing double-digit increases in pharmacy count, and we were seeing double-digit increases in pharmacy pricing. So when the analysts put all of this together, and we went 5 years out, I was looking. I said, okay, the numbers make sense from a mathematical perspective. But I looked at the cost of prescription. It started out at like $50 cost per prescription. And 5 years out, it was like $2,000. I'm looking at this and it's like, okay, the mathematics work, but there's no way a cost of a particular script is going to be $2,000. So something's going to happen. I don't know exactly what it is. Something's going to happen to make that cost per prescript, price per prescription, to be somewhat less than what the mechanical process goes through. So step back, take a look at it, make sure it all makes sense. Okay. So that's the end of the presentation piece. I want to just show you one thing. I have just a basic model that I put together, and you can see here. So again, looking at the actual, so you make a series of assumptions. That's the assumptions tab. Okay, so I'm going to assume these are, so first of all, you have to determine, what are my major assumptions for my business? What are the major assumptions that I have to consider in putting a financial forecast together? So I say that the financial, I'm going to forecast over 2019, which if you look here, 2019 showed a $102,000 of sales. So my assumption is that for 2020 and 2021, I'm going to have a 5% increase in both years. My cost of sales. So I'm going to say, what are my cost of sales as a percentage of sales? Well, I went back to my income statement. Of course, life is not this easy, if you can imagine, but I'm saying, well, historically, 75% of the revenues was cost of sales, and 10% of payroll, 10% of administrative expenses. So when I go to the assumptions, I'm going to assume the same assumptions for the purposes of this. And so as a result, I have 10%, 10%, and then income tax rate. I think I have a disparity here because the income tax rate down here was 20%, and I think I had 30. It's a good thing is you could change that. So yeah, this I should get rid of this. It's a good thing you can do very easily. So I'm making a series of assumptions that affect the income statement as well as the balance sheet. And then when I run those numbers, this is what the balance sheet is forecasted to look like for 2020 and 2021 based on those numbers. And then, once you get to those numbers, you say, well, does that match my goals? This is the balance sheet, and here's the income statement. It says, is that consistent with my goals? Am I happy to have a slight increase in revenue and a slight increase in income? Is that consistent with what I'm looking for? And if not, you may go back to the drawing board and then start all over again and say, well, okay, let me consider some other things because I want to do more business. And when you don't like the results and you start to want to do other things, that's where it's a stretch, and that's where the financial forecast can get less reliable. So again, try to keep the bias out of the business and consider it. So the key takeaways from this is financial forecasting is important. It's the issue is you're guessing into the future, bias enters into it, and to the extent that you can look at what the results are from just a reasonableness perspective and say, hey, this makes sense, or this doesn't make sense, that's going to be a very important component. So sorry to talk so fast. I wanted to leave some time for, it's exactly 12:45. That's what I was hoping for, which is very unusual for me. So I'd like to open it up to questions, thoughts.
Everyone, very much for your attendance and your interest in this topic. And I can certainly circulate the materials to those of you who have joined. I should have your contact information through the registration on CVent. So thank you again, and we hope you all have a great day. And it looks like it's going to rain out there, so stay dry, everybody. Thank you again.
Okay, everybody, thank you. Take care.